Good evening, everybody. Hope you're well, hope you're good. I just wanted to welcome you to tonight's dinner as we're talking everything property. And yeah, today it's the beginner's guide. So I hope that you're going to have a great time. Now, I just wanted to say thank you so much to all the family members that, are supporting this platform. They're always around with these dinners. I just wanted to say thank you so much from the bottom of my heart for all your support. And I just wanted to say, man, may you just keep on, keep on supporting this ministry. I call it a ministry because I believe that's what it is. Yeah, and I hope that, you're finding value in these dinners that we are doing because the whole idea there is really to break down, this concept of wealth. So we want to break it down and make it as simple as possible. So that's why we have different components of it. And for those who are joining us for the first time on these dinners, we want to say welcome to every one of you. May you feel at home and may you just relax and have fun. Now, can I just ask that, if you don't have a pen and paper, quickly 1 minute so that you can be able to get a pen and paper or something to write on. Because I'll be moving a bit fast because there's just so many things that I need to cover. So please just quickly, maybe if you can get that quickly, I'll give you a minute and then we'll start. Can everybody hear me? Is everybody good? You can hear me loud and clear? Can I see a high five somewhere if you can hear me? All right, so you can hear me, right? Fantastic, wonderful. All right, cool. So does everybody have something to write? Can we get going? All right, cool. So I just wanted to mention that today, it's been incredible 3 weeks. It's been difficult from my side with COVID-19 and all of that, and that is why I was playing very wide. You just after the experience of not able to breathe, you just appreciate yourself even more. So that the song was really dedicated to everybody. That can we just love ourselves? Can we embrace life? Can we just say thank you for every breath that we are breathing and just appreciate life? I hope that you guys are safe together with your families wherever that you may be. So on that note, I felt that I needed to give. When you want to celebrate life, you need to be able to give. So today, there's a competition that I'm running whereby I'll be giving away a copy of my book, Financial Planning for What? And we have this amazing t-shirt, financial swag. I hope everybody can see it. So this is the t-shirt that I'll be giving away together with the book. So it will be posted to wherever that you are. So all you need to do is to go to any of my social media platforms where you can find the marketing for today's dinner and be able to comment after this and just be able to provide feedback around what has stood out for you in terms of the dinner tonight. So if you can do that, and then we'll be able to choose a winner, and that winner will be able to post this amazing hamper for you. So so I did these t-shirts this week, so we're just playing around and we'll be selling them from next week. So be on the lookout for that. So one of the initiatives that I'm doing to just raise money so that we can be able to do a lot of seminars, a lot of workshops around young people, start to be able to sell and do amazing things. So please make sure that you do send your comments after the dinner and just let us know how you found the session tonight. So that's what it is. And then for those who are looking for the book, so the book is 160 Rand, and we'll be able to courier it for you. So if you want to get hold of me, it's 074 412 7614. 074 412 7614. You can be able to send your details there, or you can email me on gavcare@gmail.com. gavcare@gmail.com, and you'll be able to get yourself a copy of the book. I'll make sure that it gets to you. So please don't forget. And so those who are new, You know, all these sessions dinners are recorded, so you can be able to get you can be able to watch them on my YouTube channel titled Gav Fox Property and Finances. So you can be able to get it there. You know, all these sessions that we have done wealth protections. We've been talking about trusts. We've been talking about wills. We've been talking about property. We've been talking about youth entrepreneurship. We've been talking about personal branding. So there's a lot that you can find on my YouTube channel. Please go there and don't forget to subscribe. Subscribe, tell other people to also subscribe as well. Cool, fantastic. So today we are talking property, you know, the beginner's guide. Now, normally I don't really like to, you know, share screens and all of that, but for today, I'm going to do that. You know, when I talk property, I always want to just flow, you know, but let's see how, see where it takes us. Cool, let's see. Right, so as I said, YouTube channel, go there and be able to subscribe and yeah, and tell other people, your future pay, everybody to also subscribe as well. Okay, cool. So now, you know, when I always get this question, Gav, you know, is this the right time to invest in property? I mean, if you look at what's going on, people are losing jobs. I mean, you know, I think yesterday, you know, it was just all over the news that our economy shrunk by over 50%. Now you can imagine that is hectic on its own. And I'm sure that anybody who is, you know, you drive around, you will see that there's a lot of vacant, you know, properties, especially commercial. And that can be able to say to somebody, what do you mean, you know, investing in property when things like this is happening? It spooks a lot of people, especially from the first time. It can be a bit intimidating. But today, you know, I want to be able to break down that to say, why is this moment, this time, a good time to be able to start? If you have started already investing in property, this is also a perfect time to scale up, but it's all about strategy, okay? Now, I couldn't find a more clearer picture quality-wise. Now, if you can be able to take a note, please find this movie, you know, find this movie. It's called 99 Homes. Go and watch it. You know, when it starts, it's a bit boring. You know, when the first time I came across it, it was just a boring thing. And I'm like thinking, this old movie, it was so dull. But when you go deeper and you start to watch it and you realize there is so much, you know, things that you can learn there. I believe that this movie was prepared for now. You know, it is exactly an amazing movie that depicts, you know, what we're currently going through. So it was done, basically it depicts the time of 2008 US house crash, when, you know, it was just blood on the floor, people were losing homes. And there's just amazing thing that happens there where you can change crisis into amazing things. And that's exactly what this movie is all about. So please go and check it out. Please get it, watch until the end, and please let us know what you have learned from that. All right, so it's called 99 Homes, and yeah, it's an incredible movie. Cool. So now, where do we start, right? I want to start investing in property. Where do I start? So one of the things that I always mention, and I'm very vocal about, especially these days, is that any kind of investments that you get into, it has to tell a story. You know, the story needs to depict why and how. You know, why are you investing in property? How are you going to get this done? How are you going to be successful at it? But it has to tell a story, because I get a lot of people that, you know, they are comfortable with, you know, Gavin, I have 4 investment properties. And when I take a look at those properties, they can't tell a story. And some of them, it's actually just a waste of time. You know, so you have to understand why you are doing that, why you're investing in property, and how you're going to do it at the end of the day. It needs to be able to work in that way. All right. Now, you know, once you have that, then of course you're going to have an objective. You know, the objective is that at the end of the day, I normally say that if you are here today and one of the things or the objectives around it of investing in property is not to make money, you are in the wrong platform. You know, you are in the wrong house, because the whole idea of investing in property should be to make money at the end of the day. it needs to treat it like a business, you know, because once you treat it like a business, then the whole objective around making money becomes much clearer. Now, on when you make money, that of course, that will depend on, you know, the strategy that you're going to use. Now, I normally say that there's two parts to investing in property. The one part is the short-term basis, and then the other part is the long-term. So the short-term basis, I normally call it the buy and sell process, where now I'm buying below market value and I'm selling within market value. So let's say I'm buying in Midrand. So in Midrand, Johannesburg, the market value for a 2-bedroom and 1-bath is going for 600,000. All right. So if now I say to myself, I found a bargain in terms of a deal, it means that I have firstly subtracted, you know, the costs. The cost that will be your transfer cost, your bond costs. So those are transferred. Those are removed. And then I need to be able, if I'm buying through an agent, I also need to subtract the agent's commission. All right. And then I also need to, if there's any improvements that needs to be done in that property, I also need to subtract that. All right. And then I'm left with the base cost, because now I'll be able to say, okay, so my cost in this property is 80,000. So if now I buy this property for, let's say, 450,000. So it means that when I sell it, I'll be able to roughly make 70K profit out of it. Now that makes sense, you know, because I see a lot of the times what's happening is that we see a deal. You say this property is going for 550. You go and Google quickly what the market value is. It says 600, and you say, wow, I got a bargain. And at the time, the idea is to sell it at the profit. So of course, now when you subtract your cost, you know, you end up making a loss. So you need to be careful around your costing. Absolutely critical. Minus everything that will cost you. If you need to fix the roof, paint it with red, it's gonna cost you 100K. Minus that before you sign that offer to purchase, which is very important, okay? And then once you understand the buy and sell, short term, we are buying, we are selling, we are making money now, and that's it, all right? And then the second one is where now we talk about, yes, Amma. Okay, I cannot, let me see. Let's check. Okay, I think let's do this. Let me run through it. I'll run through it because I cannot see the comments here. I'll run through it, and then after that, then we can be able to take some questions. So please note them down as I go, because as I said, there's just a lot of things that I need to cover today. I'll squeeze as much as I can. So make sure that you jot down the questions, and when we have time at the end, I'll be taking those questions very quickly. All right, cool. So yeah, so passive income, that's where now we say, okay, we want to be able to make, I want to make 100,000 every month without having to wake up. You know, I want to travel the world, and that's what I want to make. 100K every month from these properties, because I'll be doing nothing. You know, there'll be an agent managing them. That's what I want. So there, of course, the strategy is long term. So it's all about quantity, right? The X number of tenants will give me X number of the outcome afterwards. So the 100,000, how am I going to break it down? How many tenants do I need to get to 100,000, you know, every month? But then it's long term. So that's why I say there's two parts to investing in property. Short term, buy and sell very quickly. I raise money there. And then long term, passive income. I want to make money all the time, every month until kingdom come. All right. And then I'll leave this to my kids. So those are the two things that you always need to be clear about when you start investing in property. Which one are you going with? Are you going with both, or are you going with passive income, or are you you're going with buy and sell? So it's always important to understand where are you leaning towards. All right. And then once you have that, then we come to you know, breaking it down to say, okay, cool. Now we have broken it down short term, and we have long term. Now, especially when we're dealing with the passive income stage, it is always important to be able to know that you need two things within your portfolio. You need value and you need income, right? So value is where now you're saying, okay, cool, when I buy this property, I'm buying it on the basis of I now have an idea that this property will grow in value, for a couple of reasons, right? So I buy today at 100 Rand, and in 2 years' time, it will be worth 200 Rand. So then I can be able to sell it at 100 Rand profit, or I can be able to refinance it. All right. So the refinancing aspect, we will be touching it on more advanced kind of data. So where we'll be breaking it down there. But that's how it works. So basically, with value, that's what you want. You want to make a profit, but that profit is mostly run by, it's either you want to then take it out, or when now the value has gone up, then you're able to go to the bank and say, bank, initially I took out the bond for 100 Rand, but now the value of the property has gone to 200 Rand. So now I want to leverage against that 100 Rand increase. So I want it. So give it to me cash. They will give it to you cash after they've done the assessments. And then you can take that 100 Rand. If you want, you can even buy another property cash for 100 Rand, or you can be able to use that 100 Rand to put down a deposit for the next property. All right. Now, what drives it? Because this is the question that I used to get a lot. So people say, but Gavin, what drives value at the end of the day? And then I sat down and I thought to myself, but there's two parts to this thing, That's where I came out with, actually, there's two boosters, property value boosters. And one is the social booster, and then the other one is the economic booster. So social booster, yeah, and please don't go and Google. You're not going to get it like that. It's just something that I came up with. So the social booster is because I said, and I say, you know what, there are certain areas that are driven by something. For example, you go and look at Vilakazi Street, right, in Orlando, Soweto. Vilakazi Street has become so popular. Tourists are coming because it has a historical, social, upliftment to it. Nelson Mandela used to live there. So every time the tourists, would come to Orlando because they wanted to see where Nelson Mandela used to live. So that on its own started to create this social environment, which in essence has boosted, Orlando, especially around the Vilakazi Street. To get a normal 4-room house there, you're gonna pay around the 700 to 800,000, because of the social impact that your Nelson Mandela's, your Archbishop Tutu's, had on that particular area. So that is why you see it's happening. Another example that I make is in Midrand. There's a place called Ebony Park. There's Busy Corner. Busy Corner came, it's a Shisanyama, and it just made everybody crazy. People would drive, which I still don't understand. They would drive from Mpumalanga to come to Busy Corner. It was the place. Then somewhere, somehow, that created value, around that area, to a point where today, there is a mall opposite Busy Corner, and it's called Busy Corner Mall. So you can imagine the influence of that Shisanyama had on that area. And then Google right now and see what a 2-bedroom will cost you at Ebony Park. So those are the things that will drive from a social element. I even normally when I go to Soweto as well, I would pass by Deep Kloof. Deep Kloof, there is a place there. There's a street, and then it's just, there's a lot of things, a lot of places to hang out. You see cars parked there. There's a nice place where I buy, quarter, and I buy wings there. It's incredible. You see what has happened in that particular area. If you're familiar with Johannesburg, Melville. It is sort of Melville of Soweto, and already that has created value appreciation within that particular place. And then the properties there are now, you're going to now pay if you want to be able to buy there. So those are social boosters. Socially, it drives the capital appreciation of the area. And then the economic booster. Now, the economic booster is where now we're talking about, things like your infrastructure. So your Gautrain, I always follow infrastructure a lot. Right now, I'm loving your East Rand, your Campton Parks, your Boxbacks, your Runbacks, your Pretoria East, because there is an earmarked Gautrain extension project going to those areas. So of course, what you want to do normally is that you want to get in before the infrastructure comes through, because technically that means that you are buying below market value. Because when the infrastructure is there, then the value of the area is going to go up, which means that the value of your property is going to go up. So there you can be able to say, okay, do I want to sell at the profit, or do I want to refinance so that I can be able to take out equity there, all right? So those are the things that are very important around it. So social booster, what drives it? It's a social thing. Economic is more on infrastructure, malls, anything that drives economically, be able to improve the value there. So that is value, all right? Now, when we come to income, then we're talking about maximization of your rental income potential. So meaning that at the end of the day, so we have things like your multi-lets. So multi-lets are things that you can be able to buy one house and then be able to reconstruct it, subdivide it, and then have maybe cottages. Then on that one property, you have maybe 5 families living there. All of them are now paying rent. So the idea is not really around the value of the area, is that you want to maximize your rental opportunity. So because now if each one of the cottages, they pay you, let's say 4,000. Now you have 4,000 times 5. That will be what, 20K now that you're getting out of that property on a monthly basis. So the chances there is that you will make a profit from the first day of tenants moving in. So there, in its essence, the idea is that you are chasing the income. You're not really chasing the value, because if you check a lot of these areas where you can do that, not necessarily they will grow in value. And normally with these kind of properties is the properties that we want to keep for a long time, because they lay the golden egg. You will always have this income coming in on a monthly basis. So what you need then is that you need both of these two things, because what normally happens is that I normally work on a 10-year period and say within these 10 years, you need to be able to at least have 10 properties, right? And then how you do it is that you need to be able to start mostly with those that are friendly from a cash flow point of view, because then they are liquid. They give you that liquidity, right? The surplus that you're getting. And then the value aspect is where now you get those properties that will appreciate in value. Because what will happen is that at the end of 10 years, you're going to sit there, especially if now you're financed it via the bank, you're going to say, okay, cool. Now maybe my exposure with the banks is 2 million. Now within that 2 million, I have these 10 properties. Maybe 4 of those are value properties. So if they've grown in value, there's equity there. So you can be able to, what you do, you can sell maybe 2 of them or 3 of them, settle the banks, and then be able to live off the remaining 7. So that's the kind of strategy that you can be able to use, which will be effective in terms of getting you to your end goal. Now, you'll find that there are people that will do only income-based properties. So yes, there's liquidity, but now you want to raise capital. You need 200,000 right now. Where do you go? So if you had the value properties, then you can say, okay, bank, I have equity in this bond. I'm sitting with 200,000. Can I have the 200,000? Refinance it, maybe build 2 more rooms, and then those 2 more rooms, the rental there, it then pays for the increased installment, because obviously when you refinance, your installment will go up because then your bond amount has gone up, right? So that's how then you play around the cycle. But as I said, I'm going to do a more advanced kind of dinner where we now interrogate a lot with live properties, and you can be able to see how that works at the end of the day. All right, cool. So once you have that understanding, so value, income. So you need to catch that value, income. That's how then you tell a story. Am I going for value? Am I going for income? Which is absolutely important. All right. Now, once you have an understanding around, value, around income, so I have a clear understanding now in terms of what I need to work on, where I'm going. Now, the question is the how. So the how is more of now, what structure are you going to use? What entities are you going to use at the end of the day? So I want you now to really, to concentrate, because this can be a bit, technical at times. So now there are 3 entities that you can use to purchase property. Number 1, you can use your personal capacity. Number 2, you can use a company. And then number 3, you can use a trust. All right. So those are the 3 entities that you're going to use. So what I'm going to do now, because I want to see if anybody has questions, because as I said, when I talk about this, a lot of the times I get questions. So I'm just going to stop the the screen a bit, and then I'll be able to just have a question. All right. Yeah, so then I'm going, so that if you have questions, because it gets technical, you can be able to ask at the end of the day. Cool. So as I said, you have personal capacity, you have company, and then you have the trust. So those are the three entities that you can use. All right. Now, there's three things that we need to look at, which is very important. Number one, we need to look at tax. Number two, we need to look at the risk against personal creditors. And then number three, we need to look at your personal estate. So those are the three things that we look at, which are very important. Now let's start with tax. So tax, let's say you are working currently, you are earning 30,000 on a monthly basis. Now you get taxed on 30,000, all right? Now what happens is that you go and you purchase an investment property. Now there's a tenant that is paying you rent of 10,000. So let's say this 10,000 is profit after cost. So you're getting this 10,000, every month that is coming to you. Now your taxable income is going to move from 30,000 to 40,000, because then that additional income that you get from rental is a profit and it comes to you. That is going to then increase your taxable income. All right. So you can imagine that the more you do that, so the more you have these properties giving you these profits, the more your income goes up. So you might not be on a bracket of 45% tax rate, but because of the properties that you have, they can then push you to 45%. Now, again, you can imagine 45%, it's a lot of money. The 45% that is going to buy PPEs and and schools in Maibuya that kids cannot go to. So anyway, story for another day. But that's where the money goes. It will go to SARS, and it's 45%. So of course, we don't want to part ways with 45%. If you're already there, you know what I'm talking about. It's just crazy. 45% that is going out, it's a lot of money. All right. So how then can we come up with the strategy to make sure that we are paying less tax? Right? Cool. Then once we have that, the second thing that we need to look at is the risk against personal creditors. Now, a lot of the times I get people that say, you know what, Gavin, I don't even have, the golot. I don't have any debts. I'm okay. I'm all right. I pay my debts on time. I've never missed a debit order even a single day of my life. I had somebody that said that last week, and I'm like, wow, you're good for you. How did you do it? So he said, yeah, I've never missed a debit order in my life, and I'm all good. But I said, I say this right now, and I say it a lot. I mean, if you think about it, if you told us right now, and then you said that in December, you told us in December, and you said we're gonna need a mask to go and buy bread, I mean, we would have laughed at you. I was like, yeah, in South Africa, we don't do such things. These are the Chinese. Chinese are the ones that go and always wearing a mask all the time. We used to actually laugh at them, say these guys shame aid, their life is really terrible. And today we are in the same boat where we have to be able to wear a mask, which is really, really uncomfortable, but we have to do it because we are back. We're good, right? All right, cool. So I was saying about, so the risk against personal creditors. So I was talking about the idea that, things happen. We didn't know that today we'll be sitting with the problem of wearing masks. Life just turned around, COVID happened, and then it just turned our lives upside down. So that's exactly what, I've come up with throughout this whole thing, to say that we always need to be able to plan as if something might happen. So when we're building, our property investment portfolios, or even, buying assets, we need to be able to make sure that we are protecting them, so that if something happens, they will not be affected at the end of the day. Cool. So personal creditor, the risk against personal creditor. So we always need to be making sure that we are covered on that basis. And then the third one is when we talk about our personal estate. So the personal estate, of course, this is where we are looking at, when we pass away, what's going to happen when we pass away. And those are the things that, we cover a lot on the wealth protection dinners where I have Osremi and really digging deep into that process of what happens when we pass away. But in the nutshell, what will happen is that, of course, there will be a calculation of the estate just to see what's going on in the estate. So within that, they're obviously going to look at your liabilities. They're going to look at your asset. So what do you owe and what do you own, right? Because there needs to be to say, okay, who do we pay off that you owe money to, and what assets do you then left with at the end of the day? So the very important thing that we need to look at is the cost associated with death. They normally say that, death is very expensive. It actually is, because the things that you need to then counter there, the first thing that you need to talk about is the tax that you're paying on your assets, because this is where we talk about estate duty. So estate duty, where it says now, anything below 3.5 million in terms of your assets will then be taxable at 20%. So that 20% will be charged on anything that you own from an asset base over 3.5 million. So you can imagine 20% that is going to SARS is a lot of money at the end of the day, but that will be money that is gone. And then the second layer there will be your executors' fees. So executors' fees, this is where, the people that are in charge, or the people that will be instructed to be able to unwind the estate, they will be able to charge that fee, which they then charge it on the gross value of your estate. So they're not going to charge it on your assets, they will charge it on your assets and liabilities. So that is money that will be gone to them, and at the end of the day, before your beneficiaries will get anything. So that money will be gone before the beneficiaries get anything. All right. And then the third one will then be possible capital gains tax. So this will be if there's any capital appreciation on your properties. So you bought these properties 10 years ago, they were worth 1 million, and today they're worth 10 million. So meaning that there has been 9 million capital appreciation there. So the value has gone up. So that 9 million will then be taxable anything between 13 to 18%. Because when it now gets transferred, because remember, you're no longer here, Gavin has passed on, this now properties needs to move to somebody, whether it's Gavin's spouse or whether it's Gavin's kids, whoever will be taking over. Now they're not going to be transferred at how much Gavin bought it for. They will be transferred at the current market value, which will then obviously there's possible chances that it might then attract capital gains tax. And SARS and the executor are what we call preferred creditors, which means that they get paid first before anybody does. All right, before your kids, before your family, before they get paid first, the SARS and the executor will get the money. But please follow the wealth protection dinners, because that's where we interrogate even further. Also, we just go deeper into that part. All right, cool. So we now have the tax, we have the risk against personal creditors, and then we have your personal estate. So all these costs that are associated when I pass away, that's where the personal estate comes in play. All right, cool. So then we have a company. So a company, this we can also use to buy our properties using. Okay, so the company, of course, when you look at the tax rate there, is 28% currently. And of course, then it means that when you look at your personal capacity, it means that from a tax point of view, in my personal capacity as Gavin, my tax rate can go up to 45%, whereas in the company it's 28%. So you can always see now, the benefit of a company there, because then I pay less tax. And of course, when it comes to the company, the nice thing about it is that the flexibility that you get around the company, when it comes to our expenses. So you can put in a lot of expenses, of course, that are justified. You can be able to put in your cell phones, your traveling costs, because you need to travel to your property. So you can then offset those costs at the end of the day, because now when you offset them against your income, it means that now the tax that you're paying will then be less. All right. So those are the things that will be beneficial at the end of the day. all right? And then the second part is that because the company, it's a separate legal entity from me, you know, so the company, it has its own identity from Gavin. It means that when now people want to come after the property in a company, it becomes much difficult because whatever agreement that I made with them, it was in my personal capacity. So that agreement was based on Gavin, was between Gavin and ABC Pty Ltd. It was not between ABC Pty Ltd and Gavin's property fund. It was not that. So it was within my personal capacity. So that is why we then want to remove, you know, the attachment of those assets from Gavin and then move it into a different structure, which at the end of the day, from a protection point of view, it really helps us, okay? And then now, when you buy in a company, the issue there that you will have is that your shareholding, right? So if you bought a property worth 300,000 in a company, so it means the shareholding there will be on that value, all right? And then that shareholding will then form part of my personal estate. So when I pass away, the calculations that I mentioned around the executives' fees, around your estate duty will then apply, you know, because then that shareholding is going to form part of my personal estate, all right? Now, we then move on to the trust. So the trust, of course, is also a separate legal entity from Gavin, all right? Now, the issue with the trust is on the tax rate, because the tax rate under the trust is 45%, you know, so that's what you're paying. And it's 45% from the first rent of profit that you are making. So at the end of the day, from a tax point of view, it can be a bit challenging. But again, you know, there are ways that you can use the tax benefit within the trust. So you can use minors, your kids, you can use them where you can then divert the tax because of course that tax rate will be low. But now the problem with that is that your kids are going to grow up and now their tax rate is going to go higher. And at the end of the day, they will be owning those properties. So if now they're clever enough and say, Mama, I want my property, I want to sell it, you know, so it becomes a problem. So those are the things that we need to look at. So another way that can be very effective is when you marry the company and the trust, right? You marry them. So I say that you marry them, but they're married out of community of property. So meaning that the powers are separated even though they're married. So what will happen there is that the trust will own the company 100%, all right? So it owns the company 100%. Now we use then the trust from an ownership point of view. So the trust will own the property, and then in the company, we use it for the tax benefit, right? So the 28% tax is what then we will use. You know, when we buy using the company. When we sell through the company. The rental goes into the business bank account, you know, so that's where we get the benefit of the tax. And the nice thing about it as well is that now, because the ownership of those properties, they don't lie in Gavin's name. It means that when Gavin passes away, you know, nothing really happens from an estate point of view. The only thing that will happen in the trust is that there will be a succession process who will take over from Gavin. Even the company who will take over from Gavin. All right, so it is very important to understand it. So they are married to each other, but they're married out of community of property. So we separate these two things at the end of the day, but they're still married. Okay, so the trust is now 100% shareholder in the company. Now, a lot of the time people ask, but what exactly is the trust? So I have an example, but this example, I can't find another example. So the way I explain a trust is that you take it as the little man, you know, the tokoloshi. So tokoloshi, you know, you own it, apparently, right? You own this tokoloshi, and then you instruct it to go to next door and say, tokoloshi, go to next door and go and show them flames, right? So the tokoloshi will go to next door and do funny things there. But if they catch the tokoloshi there, all right, and then now all of a sudden, Maki is calling you and say, Maki, I found this tokoloshi here. You know, come and see. You know, say, come see, Maki. I found something, and you know that is your tokoloshi. So when you're going over there, you say, Togolosh, you don't know me. And of course, when you get there, the Togolosh is not gonna know you because it takes your instruction. It does what you say it must do. So it's not gonna know you. So that's exactly what the trust does, you know. So whenever you need it, you control it, you can control it. But if then people want to attack your assets there, those assets are not yours. They belong to the Togolosh, which is the trust. So I hope that we have an understanding there of what the trust is. To even extend it further, for those who maybe have been following long time, I think it's a couple of years back, where Julius had issues with his SARS problems, and then they wanted to attach a house in Sentin. But then Julius says, but that house is not my house. It belongs to Ratanan Trust. So of course it was not his house. It belongs to the trust. It's not his. So it was very difficult for them to now want to attach that property because the legal entity that holds that property, it's separated from Julius. All right. So I hope that we have an understanding. But again, I will ask Osremi, you know, to keep on re-emphasizing, you know, the trusts, the wills, and all of the things. And that is why, again, next week we're going to have another wealth protection session. Please tune in for that and be able to until you know exactly what happens around your assets, around your estate, then you will be okay. All right, cool. Then, so I'll come to the questions just now. I think let me then break it down. So yeah, so that is in a nutshell. So you have your personal capacity, you have the company, and then you have the trust. So those are the three legal entities that you can use. So I'm also gonna, at the end of the month, I'm going to do a property dinner for Stokvels, because that's another interesting part where I then break down in terms of how this works as well within a group setup. So I'll be doing that at the end of the month. So just be on the lookout for the date and be able to log in for that particular day. All right, cool. So once then you have a structure. So now you see you have a story, right? The first story is we started at the beginning where we said, okay, what is our why and what is the how? You know, why we need to understand to say, okay, cool. Are we going for what type of property? What is the objective there? Are we going short term? Are we going long term? You know, do we want buy and sell? Do we want passive income? Then we have an understanding there. And then if we say, okay, we want passive income or we want to do both but concentrate on passive income, then we need to come to, all right, what are the types of properties that we need to look at? Then we look at the value properties, and then we look at the income properties. Income, we want to maximize the income on a monthly basis, so our cash flow needs to be liquid. We are making a surplus there on a monthly basis. And then value, that's where we want to leverage against it. We buy at a certain amount, we sell over that amount, we make a profit, or we go to the bank and refinance it. And then, of course, we then need to talk about the structure. What vehicle do we use? So that's the how now, on how to buy these properties we're using. So the structure is the one that helps us. And then the next part will be the financing. So financing, guys, it is absolutely important. So you also need to know how are you going to buy these properties, because I see a lot of people get stuck in that part. You know, you say, all right, I want to do this, and then you, okay, where is the money going to come from? So there is two parts to that. So you can either use cash or you use the banks. So personally, I love banks because you don't use your own money. So that's what we call OPM, using other people's money, right? So you use the bank because then you can be able to buy an asset of 700,000 without you putting 700,000 in there. And if, of course, you have the tenant paying the rent, so technically the tenant is now paying for your asset, all right, which is very nice. So the cash, and then there is bank. So of course you can do both, where you can be able to put down a deposit, you know, when you're now going to the banks. So I normally get the debate of, Gavin, do I, you know, why don't I buy these properties cash? Because then I don't owe the bank, you know, then it's okay. Now here's my take. The problem with buying cash is that you are locking the capital. So imagine now you're buying 500,000, you know, property. Now, a lot of the times is that you saved up that 500,000. All right. So now, boom, you are buying this property cash. Fantastic. All right. Now you are relying on the rental to get my income on a monthly basis, which is fantastic. You are getting your 5,000 every month. It's all good. Now, what happens when that area goes bad? All right. You lost your job. So, for example, there are people that lost their jobs and then they're sitting with these properties. They bought them cash. So, of course, the first thing that comes to your mind is that I have an asset, right? I'm sitting with 500,000 cash. But here's the problem. This is not really a seller's market, right? So people are looking for bargains. If you come now, even selling at a market value, we're not really interested, unless, of course, we have a bigger plan, to maximize income. But if the idea is to buy, at favorable prices, we're not going to buy something on a market value, so we want below market value. So now you are desperate at the time. You need money, you need liquidity because you don't have a job. So what are you going to do? Because you can't go to the bank and refinance this property, because you're not working. To refinance a property, you need to have a job, you need to have income. You need to have, if you are a business owner, you need to have financials that, are signed off. So if you don't have that, what's going to happen? You're not going to get the refinancing. So the only option that you have, because you want the money there, is that you sell the property. But now it's not a conducive market for sellers. So now if you come there and say, I'll sell it for 500,000, people like, I'll give you 450, So you are desperate at the time, you need money. Then if you then sell that property for 450, you technically lost 50,000. So you see the danger there of using your own money. Whereas one of the strategies that I normally advise is that you go for, if you can go and get a bond, but you still have the 500,000, go and get a bond, all right? If you still want to put in the 500,000, it's fine. Go and get a bond, get 100%, right? When now that bond registers, then put in the 500,000 in that bond, all right? When you put it in what we call a flexi account, all right? You put it in a flexi account, then that flexi account makes that money liquid. So of course, it's sort of like you've paid it off, but it's not closed, but that money is sitting there. So if now, you have the issues now with liquidity, COVID happened, you can go back and be able to get that money, because there's another person who did that and said, okay, cool, Gavin, I have this property, I've lost my job, I don't really need the big space right now. So what do I do? So he had done that, and then he was able now to take some capital there and be able to get something smaller and rent it out that property. And at the end of the day, then he was okay. So the tenant is paying for the refinancing, the amount that he's taking, because it's not refinancing, it was in a flexi, so you don't need to refinance. So the tenant is now paying for that. So those are the things that you use. Liquidity is absolutely critical, and it has proven now to say that when times are tough, when there's crisis, you need money to survive. So when you always have money available, you are able to even take advantage of opportunities. All right. So that's where I come in with cash, where I don't necessarily like it, unless, of course, if you cannot go to the bank for some reason, because maybe your credit score is bad, you have things there, maybe your judgments that you need to fixing, but you do have this money. Yes, you can do that. But again, it's all about strategizing. Strategize and make sure that you are doing, some of these processes correctly. All right. But I normally advise, if you can go and get the bank, go financing via the bank, go to the bank. Especially now with the low interest rate. However, you just need to be able to be careful. You need to be careful in terms of, because what I see as well, a lot of people's like, 7% is low, and they go in, boom, and now you're maxing out yourself. So you're putting yourself under pressure because, the interest rate are going to go up. So what happens when the interest rate go up? So that is where strategy is very important, because you always need to counter the interest rate going up, and that is very important. So because when you maximize the income, you're able to do that. And when you buy strategically, then the rental in those places is going to go up as well. So you always need to know how you're going to be able to counter, interest rates going up, right? Which is very important. Cool. So yeah, so then it's cash, it's bank, right? So you can do both, and it's going to be able to help you at the end of the day. So as I said, we're going to be doing a more advanced where we really dig deep into your refinancing. I'll be taking you through the cash flow, what are the nice things that you can use via the cash flow, and how you're going to be use this refinancing to help you grow your portfolio. All right, cool. So yeah, so those are the things that are very important that you need to look at. You need to tell a story when you start investing in property. Why are you doing it? What is the outcome there? So let me see the questions that are here. Please post them quickly. I think we have about 10 minutes to go, and I'll be able to take those questions. Hi, Gavin. Looking for bargains during this period, but how does one ensure they can pay the bank once they buy property as people are losing jobs? What strategies can one employ? So look, within this, somebody asked me yesterday, if you still have a job, you still have a job, because at the end of the day, you take that, it's a risk. We don't know what's going to happen the following day. But the nice thing about investing in property is that, if you buy the right kind of properties in the right kind of area, you know what you're doing, there will be a tenant that will be able to pay for that. I mean, as I say, I know a lot of people, I have a lot of clients that currently they've lost their jobs, but they're okay. So what they've done, some of them, they've just moved out of the property. As I said, you get even live in a room. There's one that is living in a room and said, Gavin, until I can find another job, then I'll stay here, because I mean, at the end of the day, his property is giving him, a surplus. So through that surplus, he's now able to pay for the room, which is fine at the end of the day. So he still kept his property, and then there's the tenant that is paying there. And of course, when things turn around, then he can be able to move back. Well, he's not going to move back to the property, because now he wants more. So that's an idea. So what I normally say is that if you live, you cannot be paralyzed by fear. Myself, I don't know what's going to happen tomorrow, but you always need to be able to say, whatever it is, I'll make a plan. If I have to go and sell Titamati, I will do that at the end of the day. And that is why I know this is not what we were here for today, but that is why you always need to look at multiplying your income. Guys, that is very important. Even if you make an extra 500 every month, please do. Tomorrow we are having the networking for wealth dinner. Please be able to tune in there. Just get, even if you're not going to do your forex trading, even if you're not going to do your Herbalives and all of that, but try something that will give you extra money, because it expands your mind, and you start to see all of these opportunities. Even if you lose your job, you still have some sort of income. So those are the things that you need to do. All right. And yeah, so I cannot stress that enough, to maximize your income stream. Try other things that can be able to help you there. So those are the things you can look at, but don't be paralyzed by fear. We all don't know what's going to happen tomorrow, but we are still pushing ahead nonetheless. We are investing nonetheless, because at the end of the day, when we make it, we're going to be making it. If we fail, but at least we failed, we tried. So don't sit there and say, but losing job, lose my job and all of that. And as much as right now, people are losing jobs, tenants, obviously there's the chances that you might not find tenants and all of that. The economy is going to pick up. Mark my words, it's going to pick up again. People are going to get employed again, and there's going to be opportunities. We've been here before, maybe not in this kind of magnitude, but we have been. 2008, we thought the world was coming to an end, but it bounced back. Then there was 2010. We had forgotten about all of these things, and it picked up again. The prices went up. All of that. So it's going to pick up. But this is the time to invest, because when it's bad, people are conservative. That's where you're able to negotiate. That's why you're able to strategize much better. There is now good deals on the table, because where the economy is. So that is where you get in. Because you can imagine, when in a good economy, everything is hunky-dory. So to get in there, get bargains, you're not going to get, because people are employed, people are okay. But now it's tough. So that's where you come in, and you're able to take advantage of the opportunities. All right, cool. So I hope that I've covered that. Yeah, the Togoloshi. Yeah, it's, I can't find a better example to do that. All right. Okay. I think it's clear me. I think I'm pronouncing correctly. Is it then better to buy property in a business structure than buy it in a personal capacity? So ideally, as I said, it will be better to use a company, but again, you might not have capital, because remember, when you buy using a company, and especially when you're financing it via the bank, you might not get 100% bond. So meaning that you would then need to supplement, the balance of purchase. So maybe in that regard, if you don't have the capital, you can still start in your personal capacity, because then you might be then chasing the 100% bond. And then within that, you know that the second property that you buy, you can be able to use the first one as a cash cow. So meaning that you buy it for value. When it increases in value, then you can refinance that capital appreciation and then pump it into the next property as a deposit. And that one you buy it in a company. So there are different strategies that you can use. So it's not a one size fit all approach. I normally say that it's better to start, and then as long as we have the strategy going forward and what you'll be doing there, it's absolutely important. But yeah, so the better way to do it, it's actually in a business, because you don't want those properties to be attached to you. All right, cool. I don't know who is this, but if I sign surety, I presume it's surety, to buy property for a PTY, and after learning about the marriage of a trust and a PTY, will I be charged to change ownership of the PTY? I'm 100% shareholder to a trust. Will the bank then finance me? Will the bank that financed me question this, as they wanted a share certificate? So here's the thing: you can be able to move the ownership. However, obviously there are cost implications there, and you then need to be able to go to the bank, as you said, and the bank needs to approve it. Now, a lot of the banks will do that subject to how the structure is. So for example, with the trust, if now you have a trust and you have, so you bought this property in your personal capacity, then you want to move it, for example, in a company which is attached to the trust, but then you have different trustees there, that's going to be a problem, So there's rules with the different banks which they will look at. Some of the things they won't look at, some of them will. So many times you have then clients that will do their conversion, move their shareholding into the company. So you can definitely do that, but that's where we also need to advise the bank, because sometime as well, what will happen, especially if you financed it, because remember that, okay, here's the thing. When I go to the bank in my personal capacity, the chances of getting 100% are higher than if I go with the company. So normally what will happen is that when you go to the bank with a new company, all right, so that's normally I would recommend, is that you use a new company, because then it doesn't have financials. So what will happen there is that we will put in the application in the company's name, but because the company is still new, it doesn't have financials. So what will happen there is that they will do the credit assessment in my personal capacity. So they will want my pay slips, they will want my bank statements, and then they will assess my affordability based on Gavin. And then if then I check out, they will then grant the bond in Gavin's property PTY LTD, for example. All right, and then Gavin will stand surety for that company. Now here's the thing, and I think when we did the session around bond, and then I had Tim, I asked that question to say, but how is it that the process is the same, what I just explained. So the process is the same. If I went in my personal capacity, they will want my pay slip, they will want my bank statement. If I went in the company that is still new and I'm standing surety, they will want my pay slip, they will want my statement. However, the outcome might be different. In the personal capacity, it might come at 100%, but in the company, they might give me 95%. So that is why it's also important is now when you do the conversion, you might not get the 100%. They might then give you 95%. You see, so then that becomes a problem. So you always need to look at those things to say, is it better? Is it not? As I said, if you already have a property now, it's in your personal capacity, maybe it might just be the fact that just use that as a cash cow, especially when it appreciates in value. Just keep refinancing it, take that money, pump it into more properties that you would buy in the company structure. So I hope that I have covered you on that. And then Tabang, please explain the implications of buying using each vehicles. Do they affect the chances of qualifying for the bond? So I think on that, if I am understanding the question, I think I've explained exactly how they work in terms of when you're buying a personal capacity and then if you're buying a company. And the trust is still the same thing, you know, in that process, it works the same. Yeah, many questions on job losses was based on tenants losing jobs. What measures do we employ to ensure that we're still good if we don't find tenants? So in that case, that's where it is important, again, going back to liquidity, all right? Because again, we're in the process now that everybody's in the same boat. You know, it's the economy, which is very difficult. But again, it depends where you bought, what type of property that you bought, because that also plays a role. So if, for example, you have a mixture, you have multi-lets, even if maybe two people then lost their jobs, you still have other, tenants. If on the value side, wherever, depending on where you bought, there's some areas that you still have okay in terms of the rental and all of that aspect. But, you know, to make sure that you sort of like cover yourself. I mean, again, it's still risky, you know, it's an investment, but liquidity is very important, because if then you have the liquidity, so you can say, okay, so I know that the economy is going to take some time to pick up, maybe for the next 5 months, right? So you can still then, if you don't have a tenant, you can still supplement. The other thing that you can do is what we call the rental insurance. So you can take up that. So the rental insurance is where it covers you if now you don't have tenants, if tenants default. So those are the things that you can also look at. So there is an insurance that you can take up from a rental point of view. But as I said, apart from that, I really don't know what I can really say. So liquidity, rental insurance, and as I said, make sure that when you buy the properties, you understand exactly what you're trying to achieve, because there you can always come around with the structure. And the other thing, which is very important, make sure that when you're financing these properties, you can carry the cost. So because that's where I spoke about the exposure, because then people push themselves to the limit where, you know, you're comfortable with these properties paying for themselves, but you don't have some leg room for yourself within that property, or within your finances. So of course, if now you don't have a tenant, you're gonna find yourself in trouble because you can't carry the cost. So make sure that whenever you go for those properties, when you do your costings, they still fit in somehow within your budget, so that even if you don't have a tenant, you still fine in that regard. And the other thing that I need to mention is that we always need to be creative as well. You know, so when things happen, we always need to adjust very quickly to say, okay, if maybe to a student accommodation, I don't have students, maybe I do short-term leases. So a lot of my clients who did short-term leases and then they were fine. Some, what they did is that, you know, through that, they were able to turn around and say, okay, how do we become innovative where they reduce the rentals? Because that's another issue where people, you stick to your original rental, but it's in tough times. So now a lot of us, we had to reduce the rentals. So adjust that, and then you see that you have tenants. And then when the economy picks up, then you can increase the rentals again. So those are the things that you can be able to use. But other than that, it's still, the risk is still there, you know, so you just make sure that you have a strategy that you can use. Can you explain refinancing? So as I said, I'm going to cover that on the next session. As I said, we're out of time, but I'm going to cover the refinancing aspect because I normally want to explain it and then show you how it works. So I'll be able to use it on a cash flow, and then you're going to see it very nicely, and it's going to be able to help you in that regard. Okay. Can I still be able to buy a property if my net income is less than 10,000? You see, that one is the one that actually I'm going to do a session just for that, because there is that, I don't know, it's a mindset thing. It's like all of a sudden when the income is less than 10,000, we're thinking we're out of the game. No, there are properties that you can get, you know, even any less than 10K. You can start with the flat, you know, the flats that are going for 200,000. and then you get a tenant paying 3.5. So those are the things you can look at. So what you can do, which is a simple exercise, wherever that you are in that area. So go to quickly property 24, private properties, and then say flats, 200,000, and then see what pops out there. The other thing is that depending on whether you have capital or not, you can even buy things like your RTPs. That is still investing in property as long as there's a title deed there, because that's another thing that I don't get. When you start talking RTPs, people's like, somehow that's not property investing. And I have ladies in Ebony Park that have RTPs and are making 60K every month, out of these RTPs and rooms. So it's investing. There's money coming in at the end of the day. So please don't sell yourself short if you are earning less. The other thing that you can do is that you can partner with somebody. Maybe you have a brother who's also earning much. You guys can do joint bond if you want to go to the banks, and you can be able to do that. The other thing is that I'll also I'm going to touch on that when we do the Stockfell one, just in terms of how we can work around creative financing at the end of the day, because there are ways that you can use the power of the collective to raise capital and to get into the property game, not necessarily having enough income to be able to get into certain things. But start with what you can. Start with what you can, which is very important. So don't say I'm earning less and then that's it. So as long as when you work around your your cash flow, your budget, it is okay. And make sure that your credit profile is good. You don't reverse debit orders, because that's going to be a problem. But make sure that you are clean, your credit score is good, and then you can be able to get financing, especially now, which is good because now the interest rates are lower, and now the qualifying process has become also lower, so you can be able to get some properties there. All right, cool. All right, fantastic. So yeah, so I hope that I have covered that. Okay, yeah, the short term, yeah, it's more around your flips, and which of course we're going to have a session that will be doing a lot of interrogation on what you'll be looking at, what costs you need to be looking at, how do you spot it's a bargain, where do you go, all those kind of things, and then I'll be able to cover that. All right, cool. So yeah, so we've come to the end. I hope that you have benefited from this, and then be able to shed some light in terms of if you want to start, then you can be able to start. And as I said, guys, the risks are always there. I'm not gonna sit here and tell you it's hunky-dory. It is tough. I get clients that call me and say, Gavin, it's really tough, and say, hold on, because it's gonna get better. And when you get better, you will be the one laughing all the way to the bank. So this is the time. So get in, as long as the strategy is good, as long as you know what you're doing. And that is why I'm doing these sessions, so that I can be able to point out certain things that you can do, but you need to start. That's the only way. If you're gonna sit there, wait for the economy to be good, you're going to pay prime price, because remember what's happening with the banks. They are taking now heat. The defaults are high. So what do you think is going to happen when the economy picks up? Of course, they're going to clap us from an interest rate. They're going to give us higher interest rate because they need to work. They need to make money again, because they're taking a hit now. So please make sure that you get in before the end of the year. You have something. It doesn't matter how much it is. As long as you have started, it's very important. And you'll see that you will start to be able to, it's like a drug. Well, once you get in, you want more and more. So yeah, but the starting is very important. So quickly, as I said, I'm giving away the book. So go and comment on where you saw the marketing for tonight's dinner, and write up in terms of what are the things you picked up tonight. And yeah, you'll be able to get this. And we will be able to get this nice t-shirt, very nice, and then you're wearing your jean there, and then all good, you're all nice. Please, yeah, so then I'll be able to post it to you as a hamper, and then you'll be able to be good. So as I said, if you want the book as well, 160, 200 if I need to post it to you, hit me up on 072 412 76 074 412 7614, 074 412 7614, and then you can send me an email on gavcare@gmail.com. And as I said, please go to my Facebook, to my YouTube channel, Gav Talks Property and Finances. Go and subscribe. Go and subscribe. And then we're all gonna be good. And then yeah, the t-shirts are coming out next week. You can be able to purchase yourself a nice t-shirt, because we need affirmation, you know, affirmation that we born, we are financial, we're working in financial greatness. And please be on the lookout for my financial sermons, as always, you know, posting them on my social media platforms, and be great. Yeah, cool. So yeah, may you have an awesome and incredible night. Yeah, man, stay blessed. It's Gavin Kabela signing out, and I'm gonna see you on the flip side.